Yes, happy morning, people. So today we'll be covering MTP 1 May 2024 wala MTP 1 series we'll be covering. So overall, before we start, so how is this particular MTP? Sir, if I have to tell, only about 4 questions. Probably is newly added, pretty straightforward ones only. All right, but good, little different questions. We'll get to learn a few things from these 4 questions, and some MCQs have been added. I don't think so MCQs and all are anything new. It's pretty much using the same old concept. They built some MCQs, so that's all. So overall, if you go through these MCQs, I mean these questions, MTP 1 or MTP Series 1 of May 2024 should be done according to us. Rest everything is class repetitive questions. I'll also give you a reference of that, referencing class question ka referencing number I'll give you. Yes, people, without delay, let's get started. So first case scenario number 1. They've told that this company is diversified company, big company and all that we don't want. The year is ending on 31st March 20x3 and they're facing some accounting issues which we need to help them out. So first part of the case study. Again, as I told you people, before we actually dive into the case study, always it's a good practice to look at the requirement. What is quickly there, or what are they asking? So one, they are talking about some classification, whether current, non-current, etc., etc. These two are classification wala question. Then they are asking about valuation of raw material. Okay. Then they're asking about revenue recognition. Great. Okay. So these are the questions that is revolving around the first case study that they're given over here. So with that in mind, let's read this case. One of the businesses of ABC Limited, one second, is manufacturing sugar and chemicals. The company has taken a term loan of 5 crores from State Bank of India to buy a certain plant and machinery for the current year. Okay, great. They purchased, or maybe they purchased it in last year only. Current year is ending on 31st March 20x3 now. So they purchased a machinery. The loan was repayable over 5 years. So it's a financial liability, and these are financial liability in the nature of non-current liability because the repayment terms is going beyond 1 year. Yes. So majority of the portion is non-current, some portion could be current. Yes, depending on how you pay. The terms and conditions of the loan agreement requires company to maintain a current ratio 1:1.33:1, meaning current ratio has to be 1.33. Normally when banks give out a loan, right, they will put in some conditions. So one of the conditions here is current ratio should be maintained at 1.33 and debt equity ratio should be 1:2. So debt equity ratio should not exceed 2 basically. That's what they're trying to say. If these loan covenants as in restrictions, fall below this level, then the bank has a right to recall the entire loan. So if you breach any of these terms, bank has a right to demand the repayment. Usually the loan term here given is 5 years. But if you breach this condition, bank can ask for the repayment immediately. We have done such questions. Yes. The loan outstanding as on 31st March 20x3 was 4.25 crores. Great. The current ratio was 1:1. So required current ratio was 1.33:1. But now it has become 1:1. That means current ratio has fallen. Debt equity ratio has become 0.5:2. 0.5:2 is nothing but 1:4. Debt equity ratio should not exceed 2. Now it has become 4. So debt equity ratio is also crossed. The current ratio is also crossed. That means this particular limits has been breached. Right now, both one should not be breached. Here, both are breached over there. But even if one gets breached, the bank has a right to demand the repayment. So what did the State Bank of India do? State Bank sent a notice on 5th April. After our year ended, current year is ending on 31st March. 5 days after our current year ended, the bank sent a notice demanding the repayment of the loan on account of breach. The financials were signed on 10th May. This is a date on which financial statements are approved maybe. On receiving the notice, CFO of ABC negotiated with the bank and ensured to rectify the breach. And as a result, on 25th April 20x3, bank has agreed not to recall the loan and allowed the company to achieve the contracted current and debt equity ratio by contract the current and debt equity ratio by 20x5. So here we have done a breach. After we done the breach, 5 days later, that is on 5th April, bank sent a notice saying they want their money back. Then our CFO went running to the bank and he negotiated and he convinced the bank saying we will rectify the breach, and bank gave us some time. They are not ignoring the breach. Bank told you rectify the breach. That's what they're saying. This breach has to be contracted, meaning it has to be rectified by when? 20x5. So they've given, we are in 20x3 now. They have given time till 20x5. So 2 years time has been given to us. Grace period has been given to us. Okay. So these sort of questions we have done. We have done 2 scenarios. This is slightly different. Hence all the 3 types of scenario I've written it here for your reference. One scenario is the bank will ignore the breach. You have committed a breach, some condition you violated, where bank will say it's okay, oofy. Okay, the bank told no problem, it's a small breach. I will ignore it. Where bank is not expecting us to rectify the breach. They are telling bank is ignoring the breach. That's a case study we had done in the class. If the lender, that is bank, has chosen not to demand the repayment, okay, before the approval of financial statement, meaning if they are ignoring the breach and the bank is saying I will not demand the repayment within the approval of financial statement, then we say this is an adjusting event. Then this particular loan, no, you still show in your current year as non-current liability only. So loan is anyway non-current liability. No. Since you committed a breach, right? Since you committed a breach, the loan has become repayable on demand. So any loan which is repayable on demand, right? Any loan which is repayable on demand is a current liability. Okay, so on 31st March, this loan is a current liability because you have done a breach, and due to that breach, the loan has become repayable on demand. So this is the current liability. But what we have one Ind AS 1 ka provision says is, okay, or Ind AS 10 ka, this is also adjusting event. Okay, so if the lender, meaning the bank, if he is chosen to ignore the breach and not demand the repayment when before the approval of financial statement, here financial statements are approved by 10th May. Before 10th May, if the lender says I will not demand the repayment, I will ignore your breach. Then we treat that as an adjusting event. So meaning from adjusting event means from current liability, again you will change the classification to non-current liability. This scenario we had done in class. Okay, now people, yes, so in the current year, you will show this loan as non-current liability only. Okay, but this is which case again? When the breach is ignored by the financial institutions. Here is the bank ignoring that breach? No, they are asking us to rectify the breach or correct the breach. In case of rectification of breach or correction of breach, there could be two cases. One, this also we have done. If the lender has agreed by the end of the reporting period, before our current year ends, if the lender told, I will give you 12 months grace period within which you can rectify the breach. Okay, before the current year ended, the bank told us, I will give you 12 months time, you rectify the breach before then. If that is the case, means the loan in the current year will still continue to get showed as a non-current liability itself. So what is this case again? Before the 31st March, if bank tells us, okay, that we will give you a grace period of 12 months to rectify, then the loan in the current year can still continue to be showed as non-current liability. Is this particular scenario playing out over here? No. Here, are we getting grace period? Yes. But did we get that grace period by the end of the reporting period or after? Here, the bank gave us the grace period on 25th April. 25th April is coming after the year ended, no? So if the grace period of 12 months or more, it could be 12 months or more, whatever, if it is given after the reporting period, which in this case is after 31st March, on 25th April, we received in this particular case, the grace period. If the grace period is received after the financial year ended, then that particular loan will be shown in the current year as a current liability. So this is the thing. These two cases we had done in class, the problems. This is what this particular case study is trying to say. So it looked similar. There is a small adjustment, extra fitting. That's the reason I've written all the three for your reference over there. Just a quick summary I'll give it for all the three. So one, if the bank ignores the breach, they're not asking us to rectify. If they ask us to, if they say we will ignore the breach, okay, and this ignorance of breach is done before the approval of financial statement, then in the current year, you will treat this as an adjusting event and the loan will still continue to be shown as a non-current liability itself, meaning non-current financial liability itself. That is one case. Or second case, if bank gives some grace period, you need to check when is that grace period given, before the current year ended or after the current year ended. If the grace period is given before the current year ended and if the grace period does not exceed 12 months, then in the current year, you will show in the current year financial statements, you will continue to show this loan as a non-current liability itself. That is one. However, if the grace period is given after the financial year has ended, that grace period could be 12 months or it could be more. In this case, it is more, it is 2 years, right? So if the grace is given after the current year has ended, then that particular loan you will show in the current year financial statements as a current liability. What sort of current liability? Current financial liability, not other current liabilities. It's a current financial liability. Okay, now sir, this is the answer. So we have read the case now. Let's see what is the MCQ question all about. How the long-term loan from SBI has to be classified in the financials for the year ended 31st March 2023 in case ABC had not negotiated. They're saying if this negotiation had not happened at all. They're giving a different scenario. Okay. In the reality, negotiation has happened, but the question they've given is slightly different. If negotiation had not happened means how will you show this loan? Sir, you have committed a breach. Due to your commitment of breach, right? The loan has become repayable on demand. Any loan which is repayable on demand is obviously what? It's a current liability. And what? Other current liability? Oh, no, it's a current financial liability. Loan, no? Loans are all a financial liability. So don't select other current liability. Select current financial liability. Okay. All right. Next, after negotiation with State Bank of India, how the long-term loan has to be classified in the financials. Now they're saying, now they've given an actual question relating to the case. Now, in this particular case, has negotiation happened? Yes. Okay. Did the bank ignore the breach? No. They're asking us to rectify the breach by giving grace period. When are they giving grace period? Before current year ended or after? After. Sir, if after the current year, if grace period is given, means you will classify this loan as what? Current financial liability. So in this case also, the answer will be current financial liability itself. Okay. So that way, this is a good question. So I've called out all these three for your reference. Done? Okay. So let's go for question number 2. ABC has an inventory of raw material of 10,000 units. Now, the moment you see raw material, you know, raw material ka valuation is dependent on the finished goods. If finished goods is valued at cost, then raw material also will get valued at cost itself. If finished goods is valued at net realizable value, then raw material will get valued at usually the replacement cost. The provision is cost or replacement cost, whichever is lower, but in this case, replacement cost only will be lower. That's what we have discussed. Yes. So read this in mind. We have 10,000 units of raw material. The carrying amount, meaning the cost of that raw material, is 100. The market value of the raw material is 95. Replacement cost 95. Okay. That means the raw material will be directly valued at like this, 100 or 95, whichever is lower. No. Raw material ka valuation is always linked to finished goods. So let's see. ABC Limited will use raw material to manufacture a component, that is finished goods. The conversion cost for making the finished goods would be 130. So that means what and all is the cost of finished goods, sir? One cost of raw material is 100, okay, and conversion cost is 130. Then ABC Limited estimates the cost of completion and sale would be 50 rupees. There's a further completion cost. So if you add it, we don't know the nature of this exactly, but even if you consider this, the final cost of the finished product will become 280 rupees because they have given completion cost and cost to sell. Selling cost is not included in the cost of inventory, no? But either ways, whatever for analysis purpose, if you consider, if whether you add 50 or if you don't add 50, the final analysis will not change. Check. If you add all the three components also, cost of the raw material or cost of the finished goods will become 280. What is the selling price of that component? Component here refers to finished goods. The selling price expected to be 290, sir. So net realizable value is 290. Cost is 280, NRV is 290. So inventory will of finished goods will get valued at what? The lower of the two, which is cost itself. So since here finished goods are valued at cost, raw material also will get valued at cost itself. And what is the cost of raw material? 100. How many units of raw material you have? 10,000. So ultimately, what is the value of raw material ka closing stock? 10,000 into 100, which is 10 lakh rupees. That's all is answer. Okay, sir. If entire units of raw material is there as closing stock, then value will be like that. At what value will the raw material be measured in the books? 10,000 units, each ka value will be taken as cost itself. As finished goods is valued at cost, raw material also will get valued at cost. So the 10 lakh would be the right answer. Here they have given 1,000, meaning this number they have expressed in thousands. Okay, 1,000 and multiplied by 3,000 if you do that is nothing but your 10 lakh rupees. So C for Chennai is the right answer here. Okay, next they have given another case around this. So let's read the next case and come. ABC has sold a machinery for 900,000, meaning 9 lakh. To a new customer. To get into a long-term relationship with the customer, the terms of the sale also include after-sales service to be provided for the next 3 years at free of cost. So this is probably a major customer to kind of make him buy more goods from us, meaning to make him transact more with us. So we have given an offer. We told the customer, buy a machinery. We are probably a machinery dealers. So we told him, buy a machinery from us for 9 lakh rupees. We will give you 3 years ka service cost at free. Okay. All right. The company also sells sales service contracts separately. So that means this machinery and sales, no, they're not highly integrated. So if the sales and machinery, if they are highly interrelated, then they become one performance obligation, right? So here you can sell machinery separately, service separately. So that means what? They are a distinct. The goods is separate here, service is separate over here. So we have how many performance obligation here? We have 2 performance obligation. One is the machinery and second one is machinery ka service. Okay. Normally, the company sells sales service contracts separately, where the customer buys it after the initial warranty period at 1 lakh rupees. 100,000, that is nothing but 1 lakh. Normally, we sell this service cost for 3 years. No, we are giving that for that service, we charge 1 lakh rupees. But here to this customer, we have given it at free of cost. Sir, that is your agreement. We don't do the accounting on the agreement basis. We do the accounting over substance over legal form. What does Ind AS 115 say? Identify performance obligation. Here, how many performance obligations we have? 2. And what? The transaction price. How much is the transaction price? How much are we collecting from the customer here? 9 lakh. The transaction price has to be allocated to all the performance obligation. Yes, no? Transaction price of 9 lakh should be allocated to performance obligation here. One is your machinery, another one is machinery ka service. So in what ratio you do this allocation? We have studied this. The allocation of transaction price among the performance obligation is done in SSP ratio, meaning standalone selling price wala ratio. Standalone selling price means to a similar customer under similar circumstance, if you sell the goods or service, what price do you charge? That only we call it as SSP. Here we know this. No? SSP of machinery. Machinery we sell it for how much? 9 lakh only. And what is the standalone selling price? What is for service alone? How much will you charge? They only told over here it is 1 lakh. So standalone selling price is 9 lakh and 1 lakh for machinery and service respectively. So the ratio is 9:1. So the transaction price, how much is that? 9 lakh. The 9 lakh will be allocated in the ratio of 9:1. So how much is the transaction price allocated to machinery? 9 lakh into 9 by 10, which will be 8,10,000. And transaction price allocated to service performance obligation will be 9 lakh into 1 by 10, which is 90,000. So this way, if you add these two, obviously you will get 9 lakh, right? This way 9 lakh got allocated to the two performance obligation. So why is this allocation necessary? Sir, machinery ka perform, you recognize the revenue when performance obligation is satisfied. Now, machinery ka delivery, we have done it today. So our obligation is complete. So machinery ka revenue you can recognize immediately. But what about this service revenue of 90? You are giving the service for 3 years. That means this particular 90,000 has to be recognized immediately. No, over a period of 3 years. That is the reason this particular allocation becomes necessary. Revenue of machinery of 8,10,000 is immediately because sale is already done. 90,000 revenue relating to service will be booked over 3 years. This is the conclusion. Now we'll see what is the requirement. How should the revenue be recognized? They're asking. We know all this. No, 8,10,000 recognized in the year of sale. Okay, and 90,000 service revenue should be spread over 3 years. So D for Delhi is the right option for fourth MCQ. Pretty straightforward. This is an all simple question for us. No, but we have done enough number of questions like this in our regular class. Okay, moving along. Case 1 is done. So let's move along to case number 2. DEF is again they've given story big company in there. Okay, that we are not relevant. Current year is ending on 31st March 20X3. That is the most relevant part. The team is stuck up, meaning they need some help with respect to few things. On 1st June 20X2, okay, the company DEF decided to dispose of a business and the current and non-current assets of one of its division related to specialty chemicals business, which it had acquired several years ago. One of the division they are selling off, sir. That means discontinuing operations, sir. Wait. The disposal does not involve DEF withdrawing from the particular market sector. So they are not selling off the entire, in that particular chemical business is there. No, the whole chemical business they are not shutting down. Probably they have many chemicals. Okay, so in that one particular chemical, not probably a major one. Okay, that they are disposing of. So here, in a way, this particular sentence is what is it trying to say? It is not a discontinuing operation, but rather this is a DG, as in disposal group. We have sold some group of assets and liability here. It's not a discontinuing operation. Okay, that's what they're trying to say. Okay, that means which provision, sir? In days 105. Yeah, disposal group, non-current assets held for sale and disposal group and all we have studied. No? So in days 105 ka provision, I mean this case is based on that particular standard. So on 1st June, the asset disposed were as follows. So we are selling a group of assets and liability, meaning disposal group. That disposal group has these assets. They're not given liability value. It's fine. So adding all this, you'll get the carrying amount of assets of disposal group is 63 million. All the numbers are in million. So it has goodwill also. Keep that in mind. And it has some current assets like inventory and trade receivables also. Keep that in mind. None of the assets of the business has suffered impairment as on 1st June. 1st June, there is no impairment they're telling. Okay, great. That is as per them. We have to test the impairment. This is impairment as per Ind AS 36. But we know we have a valuation of disposal group as per Ind AS 105. As per Ind AS 105, disposal group assets should be valued at carrying amount or fair value less cost to sell, whichever is lesser, right? So if carrying amount is greater than fair value less cost to sell, then you will get some impairment. That impairment will be as per Ind AS 105. That may come in. Here, what do they mean by no impairment is, there is no impairment as per Ind AS 36 is what they're trying to say. Okay. As at that date, meaning on 1st June, inventory and trade receivables of the business were already stated at no more than recoverable amount. Sir, that is irrelevant for us because the impairment loss, whatever you get as per Ind AS 36 or as per Ind AS 105, we don't allocate impairment loss that you got as per Ind AS 36 and Ind AS 105. To your current assets, to your inventory, cash, your debtors, to your financial assets, your this thing and all, you'll not allocate impairment loss because AS inventory ka valuation is as per Ind AS 2 and trade receivable is a financial asset. We do the valuation as per Ind AS 109 and Ind AS 109 gives impairment loss ka provision there. No, we use expected credit loss method and all. So for these two is out of the scope. If you get impairment loss as per Ind AS 105. For inventory and trade receivables, you should not allocate. Okay, that they are trying to say, which we already know. So basically, impairment loss will be allocated only to goodwill, PPE, and patent. If you get, we need to check. We don't know. DEF offered the business for sale at a price of 46.5. The fair value they've given is 46.5. Okay, million. All these are, which was considered to be reasonably achievable. DEF estimated that the direct cost of selling the business is 5 lakh. So this is not in million. Keep that in mind. Okay, this is 46.5 million. 1 million is 10 lakhs. Okay, so that means what is this, sir? This is 5 lakh means this, if you have to express in million, it will be 0.5 million. Keep this in mind. Sometimes provision and all full properly we will know. The converting the numbers from thousands, whole number, hundreds, million, and these way we will do some arithmetical errors. So be careful there. Okay, so this 5 lakh is nothing but 0.5 million. 1 million is 10 lakhs. So this will be 0.5 million. So how do you value basically, how do you value such disposal group? Carrying amount, adding all this, you'll get 63 million. And fair and the recoverable amount, you can take fair value less cost to sell. Maybe that is a better one. Yeah, fair value less cost to sell. Fair value less cost to sell will become, fair value is 46.5 and cost to sell is 0.5 million. So fair value less cost to sell is 46 million. So you are showing it at 63, but fair value less cost to sell is only 46. So are we getting any impairment loss? Yes, there is a impairment loss attributable to the disposal group. How much is that? These two come minus, which will be 17 million. Now this 17 million ka impairment loss has arisen as per Ind AS 105. And how do you allocate this? Same. Ind AS 36 and Ind AS 105 ka allocation rules in which way same. First you will allocate it to disposal group ka goodwill. Does this DG, disposal group, have any goodwill? Yes. How much? 10. How much ever maximum possible impairment loss you will allocate to goodwill. So out of 17, 10 will be allocated towards goodwill because 10 is the balance of goodwill. So after you allocate impairment loss, goodwill ka carrying amount will become 0. It was 10 million before here. Okay, now you allocated an impairment loss of 10, it has become 0. But is impairment loss only 10 now? No, it is 17. That means there is still a balancing figure of impairment loss. How much is that? 7 million. This 7 million will be given to other assets. In what ratio? In their carrying amount ratio. What is the other assets here? PP and patent. And what is their carrying amount? 20 million is to 8 million. So in this 20 is to 8 ratio or 20 million is to 8 million ratio, this particular 7 million will be allocated. So how much impairment loss will you allocate to PP? So 7 million into 20 divided by 28 if you do, you'll get 5 million. So out of the 7, 5 will get allocated to PP and to patents, same. 7 into 8 divided by 28 will give you 2 million. Okay, now if you allocate impairment loss, obviously carrying amount of the PP will get revised. It will become how much? It was how much? 20. Okay, and the patent ka carrying amount was 8 before impairment loss, right? After you allocate impairment loss of 5, PP ka carrying amount will become 20 minus 5, which is 15 million. And patent ka carrying amount from 8 million, it will reduce by 2 and it will become 6. This is the requirement. This is the workings. Yes. Now look at the requirements. Based on this only, there will be some MCQs. Now they are asking you, fifth MCQ, compute the value of specialty chemical division's goodwill at the date of classification after remeasurement. They are asking you what is the carrying amount of goodwill after remeasurement. So after your remeasurement, carrying amount of the goodwill has become 0. No? Entire goodwill you have written out. So nil is the right answer. C for Chennai. They are asking you what is the closing balance of PPs that we already got. No? The closing balance of PP is 15 million. So select 15 million as our answer. D for daily is the right answer. This one is relating to another case. That's all. Okay. Patent they have not asked. If they ask also, you can do it. Yes. Okay. Next, we have one more case. Okay. The government provided DEF, the company, a grant of 21 million to assist the development of factory. Okay. The grant was provided in two parts. So total grant is 21. So the 6 million of the grant was a payment by the government as an inducement to DEF to begin developing the factory. No conditions were attached. So totally 21 million grant is given. In that 6 million grant, no, government is saying as an incentive, start your factory. I'll not put any other conditions. They only told that there is just an incentive given so that the company will get that josh, enthusiasm to start the development. No other conditions were attached as part of this grant. So we know this as per Ind AS 20. If there is no conditions attached, what do you do, sir? The entire grant income, whatever you have received, immediately it will be transferred off to SPL. So the 6 million grant entirely will be transferred off to SPL account. Okay. Then what about the remaining? Remaining is 15 million that they have told here. Check. The 15 million of the grant related to construction of factory at a cost of 60 million. This 15 million grant is for the construction of a factory. So factory is a PP. So this grant is related to a specific. This is a monetary grant because you have received it in cash. Monetary means those components whose value is fixed. Your value is fixed. Yes, you have received this in cash. You have not received factory at free of cost, right? To construct the factory, government is giving you some money. So it's a monetary grant related to a specific depreciable fixed asset. So or PP, we have studied this. Whenever a monetary grant is related to a specific PP, we have two options or two ways in which we can record this grant. One is we call it as ACM. amortized cost method, or sorry, rather asset cost reduction method, my bad. Yeah. So you can reduce the grant from the cost of the asset. So whatever grant you have received, you can reduce it from the cost of the asset. That is one option. Or the second one is you can treat the grant received as a deferred income and transfer, initially park it in deferred income, and from deferred income you will transfer this grant to SPL over the useful life of the asset in depreciation proportion. Okay, so those are the two options we can have. Either reduce it from the cost of the factory or treat it as deferred income and transfer it to P&L over 40 years. Why 40 years? Because they said over here the land was leased so that the whole 60 million is depreciable over 40-year useful life of the factory. So if you treat it as deferred income, since the factory life is 40 years, from deferred income you will transfer it to SPL over 40 years. These are the two options. Now we have seen, now look at the question. What would be the treatment of 50 million grant? 50 million grant is related to factory construction, right? So there are conditions attached. So what to do? Either you can reduce the grant from the cost of the asset, or you can treat it as deferred income. So here they're talking about deferred credit, no sir. So looks like B also is the right option. Deduct the grant received from the cost of the asset and depreciate net carrying amount over the useful life. So when you reduce grant from the cost of the asset, carrying amount will reduce, accordingly depreciation will reduce. So this looks to be the right answer. What about C, sir? Why can't it be C? Show the grant as deferred credit. That's what we mean by deferred income. That is also acceptable, no? And leave the initial carrying amount of property at 60 million. Meaning, factory ka carrying amount you showed at 60 only. Yeah. Factory ka carrying amount you keep it at 60. Grant you put it in deferred income. Then after deferred credit would be released to income statement as an SPL at the end of 40th thing. So till here the sentence were fine. But they're saying whatever grant you have received, you will book it as deferred income, acceptable, and you'll transfer from deferred income to SPL, that is also acceptable. They are saying this transfer from deferred income to SPL will happen on the 40th year, not every year. On the 40th year, full amount you will transfer on. No, over 40 years you have to transfer. Every year from deferred income you have to transfer to SPL, some amount. Here they're saying all transfer happens at the end of 40th year. So hence this is not the right option. Okay, other things are not there. Hence B for Bangalore is the right option here. What about 6 million grant? That there is no conditions, no. So you can transfer immediately to SPL. That we have studied. So A for alpha is the right answer here. Simple. This is a simple case study. Yes, no. Yeah. So this also we have done. So can we go for case number 3? Yes. HIJ Limited is a global blah 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 they're dealing. Current year ends on 31st March. So they need some suggestion on few accounting. So we'll see. On 1st October. Okay. So current year is ending on. First let's see that. When is the current year ending? 31st March 20x2. So current year will be from 1st April 20x1. It will go up till 31st March 20x2. This is our current year. On October 20x1, meaning after 6 months, right? So after 6 months, HIJ subscribed 40 million rupees 1 as a nominal value. Rupee 1 notes in Z Limited. The loan notes were issued at 90 paisa. That's the issue price. 1 rupee is the nominal value of face value. The issue price was 90 paisa, 0.9 rupees. And were redeemed at 1.2. So these shares are, these loan notes as in debentures. They're issued at discount. They are redeemed at premium. That's okay. So that means we are investing. We are subscribing. So the word subscribing means we are investing in the other company ka debentures. So they're not using the word issue. Issue means, so the company is issuing the debenture. So it becomes a liability, right? Liability or equity depending on the nature, right? So here we have subscribed. That means this is a financial asset for us. It's an investment, right? So at what price did we buy this asset? We have purchased 40 million. Face value may be 1, but did we pay 1? No, we paid only 90 paisa, 0.9. So the cost is how much? 40 million into 0.9 rupees. So 36 million is what we have paid to purchase this financial asset. Yeah. Okay. Sir, this is your transaction price. Initially, we'll record financial asset at transaction price. So if transaction happened at off-market terms, we have to find out fair value. No? Have they told anything? No. Only if the transaction happens at off-market terms, then we need to find out fair value. And how do you get that fair value? Present value of future cash flows and all that. Here they have not told anything. If they don't tell anything, we assume that the transaction is done at a fair price itself, and we'll directly record initially the financial asset at same value, which is what 36 million itself. Okay, interest is payable on 30th September. Okay, in arrears at 4% on par value. In arrears means at the end of each year. Okay, that's what they are trying to say. Okay, sir, interest is already paid on this debenture. After that, 1 day later, we purchased of the bonds. Correct. Now, on 1st October, we purchased the bond. Interest will be paid on 30th September. Okay. That means, will we get any interest on these bonds in the current year? No. Because we purchased on 1st October, interest is paid 1 day before. Next interest will be paid on 30th September 20x2. Correct. No. Our current year ends on 31st March. So, in the current year, we will not receive any interest because we have purchased it after interest. That's the reason. Okay, this represents effective annual rate of 9.9%. Mean owner, sir. Financial asset means we have to do ACM accounting. For that, we need effective interest rate. So they have only given effective interest rate to be 9.9. So what is this 4%? That is the actual interest rate which the company is giving to the investor. We don't want actual interest rate. We want effective interest rate. So that is given. H limited intention is to hold the investment till until redemption. So we don't have any intention to sell off this asset. So the intention is to hold it till maturity. So intention here is to hold it till maturity and collect all the contractual cash flows. So CCF test is also passed. So we follow what method of accounting? Amortized cost method. Okay, so if you do the accounting, what will be? Initially, you will measure this particular financial asset at 36 million because no other data has been given. That transaction has happened at off-market terms and the. So we'll take transaction price itself as fair value. So initially, financial assets will be valued at 36. And then there's a financial asset. On financial asset, you will book finance income at what rate? At effective interest rate given 9.9%. Don't calculate for a whole year. You purchased the investment on 1st October and year is ending on 31st March. So first year you will calculate the interest only for 6 months. This is the important part. Okay. So finance income will be 1.7. What will be the receipt? Receipt usually will be the interest, but here current year may will not get the interest because interest is already paid one day before. Okay. Interest we will receive only in the next year. So current year receipt is 0. So how do you get closing balance? These two addition minus this. So if you add, you will get 37.782. Correct, sir. 1 year ka data we have done. Usually question will revolve around that. So let's see what they're asking. What will be the initial measurement of financial instrument? Initial measurement will be 36 million. So D for Delhi is the right option. What would be the closing balance of financial instrument? They're asking. Okay, and 31st March 20x2 at the end of the year. What is the closing balance? 37.782. So select that. C for Chennai again is the right answer. Okay, Saru. That's all. One case they gave and they asked 2 questions revolving around that. Pretty straightforward. On 1st April 20x1, next one more case they've given. HIJ commenced joint construction of a property with the G Limited. So H and G have come together and they're constructing a property. Great. For this purpose, an agreement has been entered into it that provides for joint operations. They are only told that this is a joint arrangement and the joint arrangement is in the nature of JO, as in joint operation. Obviously, we don't have to find out. In joint operation, no special new entity will be formed. The venturers will have a share in their income, expense, assets, liability. Each of them will take their respective share and we'll do proportionate consolidation method. We've done that, yes. So that wala point. And ownership of the property. All the ongoing expenditure comprising maintenance plus borrowing cost is to be shared equally. So all the 2 venturers are there, no? Every cost, every income, etc. and every asset liability, they will share equally. The construction was completed on 30th September. Okay, so construction started on 1st April and it has ended on 30th September in the current year itself. So 6 months. So should we take that as a qualifying asset? Sir, in these sort of questions, if they don't mention, you take it as qualifying asset itself. Okay. So in the absence of information, ICA also assumes that way only, because what is substantial qualifying assets are those assets which take substantial period of time. What is substantial period of time? Ind AS 23 does not give us specific guidelines. Management has to assess what is substantial period of time. So if there is no data in the question, always assume that it is a substantial period of time and take it as qualifying asset only. No logic, just a convention. This is what ICA does in their solution. I suggest you do the same as well. Same assumption for exams. Okay, the utilization of property is started on 1st January. That is irrelevant. No? Once the transaction asset is substantially complete, the capitalization stops and depreciation starts. Okay, usage date is irrelevant. The useful life is estimated to be 20 years. This is necessary for depreciation. Total construction cost was 40 crore. Great. Besides internal accrual, the cost was partly funded by the way of loan of 10 crore taken on 1st January. You might have taken the loan on 1st January. You'll capitalize the interest from 1st January. Yeah, no. You will, for borrowing cost capitalization, we have conditions. 3 conditions. 1, borrowing cost should be incurred. Expenditure on qualifying assets should be incurred. Activities relating to qualifying assets should have begun. Here, qualifying assets only have started on 1st April. So, though the loan is taken on 1st January, expenditure on qualifying assets has started from 1st April. Okay, and the activities also. So, you will start capitalization only from 1st April and it ends on 30th September. So, and what is the interest rate? Interest rate on the loan is 10%. A specific borrowing, no? So, we don't have to worry about weighted average capitalization rate. So, now, can you capitalize borrowing cost? Yes, you can capitalize borrowing cost. 10 crore is a loan amount. Interest rate is 10%. The period is only 6 months. So, you can find it out only for 6 months. So, it will be 0.5 million is the borrowing cost that you can capitalize. What is the construction cost you incurred? 40 crore. Can you add that? Yes. So, these two you can add up. Okay. Yes. Next up. Company has spent 4 lakh on maintenance. So maintenance expenditure and all goes off to P&L. It cannot be capitalized. So this will be transferred off to SPL. the company has recorded the entire amount paid as an investment in joint venture. You cannot do that. You can't, the investment in joint venture, if your account means you're treating this as a joint venture. For joint venture, we follow equity method and show investment in joint venture. So this treatment is not acceptable. Here, they only said it is a joint operation. In joint operation, each venturer will record their share of assets, liability, income and expense in their books. So here one property is constructed, okay, and the total cost of the property adding these two is 40.5. Two venturers are there, no? HIG and the G Limited. Both have to record their share. So what will be HI? They've asked the question from HIG perspective. In fact, doesn't matter. Anyway, equal share, no? So HIG will show the property in their books at what? 50% of this value. So 50% of that will be 20.25. That's all. No, there is a depreciation also. So they have to record depreciation also. So what is the depreciation H and G? Since it's equal and the period is same, both the depreciation will be same. Doesn't matter whether this depreciation is for HIG or the other company G Limited, value will be same. What is the depreciation amount? Cost of the property is 20.25. We're calculating for one entity. Yeah, 20.25. Residual value not given, 0. Divided by useful life, which is 20 years. That is, this calculation will give you a depreciation for whole year. Sir, asset was ready to use only on 30th September. But year ends on March. So October, November, December, Jan, Feb, March. So current year 6 months you have to depreciate. So if you calculate, it will be 0.50625 million, or if you want to express in full number, it will be 50,62,500. This is the thing. So both the companies, they have to show their share of asset this much, their share of depreciation so much. Both HIG as well as G Limited. Now they will ask the question C. What is the nature of arrangement? They only told us, sir, the nature is joint operation. So that is a straightforward question. What is the initial cost appearing? Initial cost of PP, initial cost, okay, not the carrying amount at year end. Initial cost of PP for HIG. Doesn't matter whether it's HIG or the other company G Limited, initial cost will be same. Initial cost means your before depreciation value, which is total is 40.5. Both the company ka share is 20.25. So you have to select C for Chennai here. Now they are asking what is the calculate the depreciation for current year for G. Whether it is G or HIG, it doesn't matter. Depreciation for both entity will be same. How much is that? 0.5625 million or 50,62,500. They have given in full number. So alpha is the right answer here. That's all. This question also over. Easy. I think same question we have done in our regular class also. Just 1 minute. Okay. F Limited is the first time adopter of Ind AS. Great. The date of transition is 1st April 20x1. They only given. On 1st April 20x0, it had obtained a 7. Date of transition is 1st April 20x1. Before the date of transition itself, meaning 1 year before date of transition, a company, this company, they have obtained a 7-year US dollar loan, foreign currency loan, 1 lakh or $100,000 loan. It has been exercising the option as per para 46A of accounting standard 11. So, AS 11 give that exemption. So, if you purchased any long-term foreign currency loan, then the exchange gain or loss arising on this long-term foreign currency loan can be either added to the cost of the asset. Okay, instead of transferring the exchange gain or loss to P&L, if the loan is utilized to buy depreciable asset, then the exchange gain or loss, instead of transferring it to P&L, you can add it to the cost of the asset. If the loan is used for other purpose, meaning to buy non-depreciable assets like land or some other purpose, then the exchange gain or loss you can accumulate in one reserve called FCMITD, foreign currency monetary item translation difference or translation reserve, FCMITD, right? And from FCMITD you can call it FCMITR, it's okay. And from FCMITD it will be transferred to SPL over the loan duration. Whatever, if the loan duration is 10 years means from FCMITD it will be transferred to SPL over 10 years, like that. This option Ind AS nahi. Okay, accounting standard 11 gave, but in Ind AS 101 they have given some exception. What is that? So if the company has adopted para 46A exemption already as per AS 11, even after Ind AS is applicable, they can continue with the same option. Okay, this is the carve out, meaning IFRS does not have this. Ind AS may this option is being given. If the company is already following this particular treatment as per AS, if this is an option given by accounting standard 11, if the company has already exercised this option as per AS 11, even after Ind AS is applicable, the company can continue with the same option. That is one. Or if the company want, they can reset this FCMITD, meaning from FCMITD, whatever balance is there, they can reset it to 0. Whatever FCMITD balance is there, straight away they can transfer it to SPL. If suppose it has 10 lakh balance, entire 10 lakh on the date of transition, you can transfer it to SPL and do the accounting as per Ind AS 21 going forward. That option is there. Or I mean, yeah, those they can apply in days 21 retrospectively, or those are some options available with the company, right? So now here, what the company is wanting to do. It has been exercising. The company has taken this para 46A exemption and it has been amortizing the exchange difference in respect of this loan over the balance period of such loan. So they're parking this exchange gain in FCMI TD, and over the loan duration from FCMI TD, they're transferring to SPL. That's what they're trying to say over here. Okay, if you want, once again, I'll read that. It has been amortizing the exchange difference in respect of this loan over the balance period of such loan. Okay, so again, that's what they mean by that. Yes, park the exchange gain in FCMI TD, and from FCMI TD, transfer it to SPL over the loan duration. On the date of transition, the company intends to continue the same accounting policy. They want to continue the same policy. Is it acceptable? Yes, they can continue the following same policy. So what will happen? Again, from FCMI TD, it will be transferred to SPL over the loan duration. Sir, so they're saying continue. Will you transfer this to OCI from FCMI TD to, will it be going to OCI? No, it will be going off to SPL. Hence, these two are not the right option. Here they're saying they cannot exercise. That is also not the right answer. They can continue with the same policy, and from FCMI TD, you can transfer it to SPL over the loan duration. Only first option has SPL. So A for alpha is the right answer for question 14. Okay, G? Yes, G. So this is the question based on accounting and technology. You know, one Chintu topic has been added. So that question this is on. X Limited is a large multinational corporation. It needs to prepare its financial statement according to Ind AS. Great. The company has vast amount of financial data stored in the system, such as in various formats, including spreadsheets as in Excel, PDF, scanned documents and all. They have a lot of data stored, okay, in their system. So it's taking a lot of space. Manually extracting and analyzing the data is time consuming and error-prone. Obviously, we have a lump of data means now we have, our materials are so big, right? So manually, if you have to sit and study the whole syllabus, can you do it in one day? Difficult, right? We need some time. And also, can you go through everything, or you may commit some errors? Errors are there. That's what they're trying to say over here. Manually analyzing this data, okay, is time consuming and there could be error. Human beings are known to commit some errors, and we learn from it and we grow. That's part of our evolution. Yes, sir. So that is what they're saying. Now, probably by implementing AI, artificial intelligence driven optical character OCR technology, some AI technology they want to introduce, the company automates the data extraction and converts it into structured format. So now they want to use AI to reduce the time consumption, processing time, as well as the accuracy, errors they want to reduce. Which of the following problems will not be avoided by implementing AI? Even after implementing AI, they're saying which problem will still continue. Meaning, in a way, they are asking which problem AI cannot solve. Manually extracting data will lead to delay in process. So currently there is a delay, okay? By implementing AI, obviously this delay time you can reduce. Yes, no, processing will happen a lot faster. So this you can solve. So they're asking which you cannot solve. A is not the right answer. B, analyzing the data manually might be error prone. So if a human analyzes the data, obviously there could be some errors. But AI is a specific program which runs on a specific instruction, right? So the amount of error between an artificial intelligence and human, obviously AI will commit a lot lesser errors. So error problem, you can sort it out. Hence B for Bangalore also not a right option. All of the above cannot be. So that means, so even if you don't know the answer, automatically here the answer is C for Chennai. So if we are seeing many MCQ, the answer is C for Chennai, sir. We will select everywhere CCC. Sir, try to solve the MCQ question. Read the data, try to solve it. Okay, and try to analyze. Okay, get the right options. Okay. If by chance, if you don't get it and all, you can do the fluke activity. Okay, don't try fluke first. Okay, yes, sometimes even you never know your luck. Fluke also may work. Okay, but try to get the right answer by analyzing your concepts. Okay, matching the case study with your concepts and try to decode the right answer. By chance, even after trying everything, if you're not able to understand which option, select something. Tell God, Allah, Shiva, Mother Nature, whatever that you believe in, and select one right option. Hopefully that turns out to be right for you. Okay, but do select. Anyway, as of now, negative marking is not there, no? So here, third one. Scanned documents of several years will acquire unnecessary office space. Sir, this problem AI cannot solve. You already scanned, you know. So scan some document means obviously your particular device system, could be your hard drive or pen drive or whatever. It's taken some space now. Okay, how can that AI solve that problem? You already scanned a document. Processing time, error you can reduce, but the space which the document has already taken, which is there in your hard drive or wherever, that the AI cannot solve, right? That will be as it is. So this C is the right option because this particular problem AI cannot solve. That's all is MCQ, all the questions. Done, sir. Okay. Now, if you see, hardly another 3 questions are newly added, and this particular session we can wind up. Okay. So only the repetitive or new questions we will do, sir. Repetitive question, I'll give you a reference number. You can use that. Question number 1 is India is 116 ka. Our question number 39 ka notes, and the referencing number I have given here is for regular notes. In the regular notes, in fast track also, all these questions will be available. You can look through. Question 2 is new. We will do it. I'll quickly tell you what and all is the new one. Okay, or maybe one at a time we'll go. It's fine. So question 2A we shall solve, sir. This is a new one. A good question. Excuse me. D Limited has a policy of providing subsidized loans to its employees. Subsidized loan as in they will not give the interest at market rate, they will give it at a lesser rate. That's what we mean by subsidized loans. We've done same problem in the question. It is there. Okay. Similar one, not same. Okay. But one adjustment, no, slightly they changed off. Because of that, this question has become slightly good. Slightly, it has become good. So that's the reason I'm solving this. Okay. If that adjustment was not there, we have done some similar question. We could have moved on. Okay. So that means the moment you see subsidized loan, one point should come to your head. What is that? Loan interest is not at market terms. It is lesser than market terms. So that means this particular transaction has happened at off market terms. We know this. Whenever a transaction has happened at off market terms, we cannot record initially financial asset or financial liability cannot be recorded at transaction price. We have to find out fair value. And how do you find out that fair value? Present value of future cash flows by discounting it at market rate. So we need to find out that. That becomes initial measurement of financial asset, or for that matter, financial liability. Thereafter, you do ACM accounting. So here that will come into picture. So you have given a loan of 12 lakh. Interest rate, actual interest rate you are charging from employees is only 4%. This is the loan given date. The principal of the loan shall be recovered in 4 equal annual installments. So that means the loan term looks like 4 years. Because you are recovering in 4 equal annual installments. Every year, 3 lakh rupees you will recover. 12 lakh you will recover in 4 installments. So installment amount, principal amount is 3 lakh rupees. Because they didn't use the word installment. They specifically use the word principal. So what about interest? Check here. The accumulated interest, meaning the total interest, computed on the reducing. Accumulated interest means the total interest computed on the reducing balance at simple interest basis. Okay, so we're not doing interest on a compounding basis. So interest is calculated on a simple interest basis, is collected in 3 equal, and this interest is calculated on reducing balance basis. So what is that reducing balance? So every year you're repaying 3 lakh principal back, no? So first year when you calculate the interest, correct? First principal you will repay at the end of first year. You have given the loan, taken the loan on 1st April, or given the loan on 1st April, and recovery starts by the end of first year itself. So first year the loan amount is 12 lakh, principal is repaid at the end of the year. So first year when you calculate the interest, no? So actual interest rate is 4%. So you will calculate it on 12 lakh of 4%. This for year 1. For year 2, don't calculate the interest on 12 lakh, right? Because it's on a reducing balance basis. So principal is already reduced. First year you repaid of 3 lakh. So the loan amount is only 9 lakh. So 9 into 4%, which is 36,000. Like this, we need to calculate interest for all the years. That's what they're saying. Accumulated interest, meaning total interest on reducing balance at simple interest is collected on 3 equal annual installments. So interest you are collecting in 3, principal in 4 annual installments. Okay. Interest in 3 equal annual installments after collection of principal amount. This is a sentence which made me to solve this question. Okay. If this was not there, no, it would have been a very, very straightforward question. It is there. Before, question number 97 or something, this question is there in our class notes. Okay. This adjustment is slightly changed off. So read this line once again. Accumulated interest computed on reducing balance. Reducing balance means when you repay the principal, loan balance will obviously reduce. So on that reduced balance, you have to calculate interest. Common sense, right? And this interest, this way you calculate total interest, right? This total interest, no, you will recover in 3 equal annual installments after collection of principal. That means loan term is 7 years. Do you agree with me? So how's it? Sir, principal you will collect in 4 installments. So first 4 years you will collect principal. Okay, then you will collect interest. How can you tell? They only told interest is collected after collection of principal amount. All the principal when it is collected, no, thereafterwards you will start collecting or recovering the interest. So principal recovery will happen in 4 years. Year 1, year 2, year 3, year 4. Then interest recovery will happen in 3 years. So year 5, year 6, year 7. Hence the total loan term is 7 years. First 4 years you will recover only principal. The next 3 years, year 5, year 6, year 7, you will only recover interest. Not me telling, question ka requirement or specification. This is the only highlight of this particular question. Okay, sir. Why must remain in service till principal interest is paid? Common sense. Yes. Market rate of interest is 9%. Since the transaction is happening at off-market terms, we need to find out present value. For that, we need a market rate. No, they've given. Okay. This and all is similar. Only one working note if you get it right. Okay. Your answer is sorted, which I'll tell you, that is the interest working note. That's all is the crux over here. Okay. If you get this, the loan term is 7 years. That one click, that point should click in your mind, and principal will be repaid from year 1 to year 3, year 4. Interest repayment will start from year 5, year 6, year 7. So what is that interest for year 5, year 6, year 7? This if you do, question over. Rest everything ditto. Only this is the highlight. Okay. They have calculated interest in fancy table. No need. I've just simplified this for you. The same manner. So how do you calculate interest? So you have to calculate the interest on a reducing balance basis. So how much is the loan amount? 12 lakh. When did the first year, how much principal got repaid? 3 lakh. When did it got repaid? At the end of the year. So first year entire 12 lakh was outstanding. So first year interest will be 12 lakh loan amount into actual interest rate of 4%. So interest will be 48,000. So second year, first year you already repaid 3 lakh principal. So second year loan outstanding is only 9 lakh. So interest will be calculated at 9 lakh at the rate of 4%. 9 4s are 36. So 36,000 is second year ka interest. Third year will be, first year you already repaid 3 lakh. Second year you already repaid principal 3 lakh. 6 lakh already repaid. Loan amount is 12 lakh. In 12 mein 6 is already repaid means balance is 6 lakh. 6 4s are 24. So third year interest will be 24,000. And fourth year mein 3 installments are already paid. So 9 lakh of principal already repaid. So loan balance remaining is only 3 lakh. 3 4s are 12. So fourth year interest is 12,000. They said total interest. That's what they mean by here. The question ka requirement, accumulated interest. Accumulated interest means total interest. So find out total interest. If you add everything, you'll get 1,20,000. Okay. This the total interest company is saying we'll collect in 3 equal annual installments. Specific word, check if you want. This total interest is collected in 3 equal annual installments. So total interest we have got it as 1,20,000. We'll recover it in equal annual installments of 3. So every year how much we'll recover? 40,000. So year 5, year 6, year 7 cash flow is 40,000 rupees. That's what it is. Okay, that's all. Now what? Since the transaction happened, this put up this as working note number 1. Working note number 2 is, since the transaction had happened at off-market terms, for a company this is the loan given. So loan given is a financial asset. So IM as an initial measurement of FA as in financial asset. Since the transaction had happened at off-market terms, we have to find out fair value. And how do you find out fair value? Present value of future cash flows discounted at market rate. So what are the future cash flows here? First 4 years principal amount will be repaid 3 lakh. Cash flow here refers to cash inflow for the company. First 4 years company will recover principal of 3 lakh each. Next 3 years every year they will recover interest of 40,000. That's what we calculated here. That's the reason I said that is the most important working note. So this is the cash flow. Market rate, they only gave in the question 9% somewhere we read, no? Yeah, here, 9%. So discounted at 9%. In fact, in the question only, they have also given the discount factor. I didn't show that maybe. Okay, it is given. Discount factor is given over there, okay? So PV factor you calculated at 9%. In fact, this is given in the question, so take that only. Calculate it. So if you calculate all this, you'll get present value of future cash flows, which is 10,43,000. This is the initial measurement of financial asset. Then as a, there afterwards, you do ACM accounting. That is clear, no? So just what is that, sir? Year, opening balance, interest at effective interest rate. Okay, effective interest rate is 9%. Why, sir? Sir, 9% is market rate. No, effective interest rate could be different. Sir, in this problem, there is no transaction cost. I have told you already in the regular class, everywhere we have repeated. If there is no transaction cost, then market rate and effective interest rate are same. So effective interest rate will be 9% only. Then receipt. Okay, repayment here refers to receipt. Then the closing balance. This is how we used to get, no? So this we used to call it as 1, this we used to call it as 2, this we used to call it in a class as 3, and this is 4. So how do you get 5? 2 plus 3 minus 4. So these two addition minus this will give you the closing balance. Okay, sir? That's what we keep doing. So initial opening balance of financial asset, we got it here, 10,43,638. Financial asset ka opening balance. On this, calculate interest at 9%, it will be 93. Receipt, repayment is what, sir? We already calculated. What is the cash flow? First year, second year, for all the 7 years, repayment clearly given over here. First year 3 lakh. So these two ka addition minus 3 lakh will give you the closing balance. First year ka closing will become second year ka opening. Now on this calculate 9% interest, it will become 75. Again receipts. First 4 years 3 lakh, next 3 years 40. So go on doing it. At the end of 7th year, the loan balance, the financial asset ka balance will become 0. This is a simple ACM accounting. Now what did they ask in the question? The requirement. If you see the requirement was journal entries. They asked. They asked you to prepare initial measurement ka journal entry. It is there somewhere. I mean, I'll just show you maybe if you want. 1 minute. Here, they have only given 9% discount factor as I told. So you just need to calculate, you are required to provide the journal entries at the time of initial recognition and on 31st March 2022. Basically, first year ka journal entry they are asking. Okay, what is the journal entry? Any problem? I hope no. 1 second. Think the recording is going on. Should be good. Okay. Now, sir, for a company, this is loan given. Loan given is a financial asset. So what is the journal entry? Financial asset account debit to bank, right? So company has given a loan of 12 lakh, but initially can you show 12 lakh rupees? No, you can't show 12 lakh rupees. Since the transaction had happened at off market terms, you have to show the asset at fair value. And how do you get fair value? Present value of future cash flows. We already did 10 lakh 43,638. So financial asset will be shown at, they have not written financial asset, you write, it's okay. Financial asset loan to employee 10 lakh 43,638. But you will credit bank to the extent of 12 lakh because you gave that much. There is a difference. What do you do with the difference? That difference depends on the relationship I had told. Here the relationship between employer and employee. If the difference is due to employer-employee relationship, you will recognize the difference as prepaid expense. If the difference is on account of parent-subsidiary relationship, then from parent perspective, the difference will be accounted as investment in subsidiary. Subsidiary will record it as equity contribution from parent. If it is lessee relationship, we'll record it as ROU. Like that I had told you. Yes. Here employer-employee relationship. So the difference will be recorded as prepaid expense. Okay. This is your initial measurement. Now ACM table ka accounting. On this financial asset, you have to book interest income. So the journal entry will be financial asset loan account debit to interest income. Refer the ACM table. What is first year interest? 93,927. So that you need to pass. Then receipt. When you receive the money, 3 lakh principal you will recover. No? So the entry will be bank account debit to financial asset loan 3 lakh rupees. Okay. Then not one more entry you can pass. This prepaid expense will be transferred to SPL over loan duration. Here loan duration is 7 years. This 156 will be transferred to SPL over 7 years. Prepaid expense. That they have not done. According to me, you can show that as well. In our regular class, we have done that. So this is the question. Okay. Accounting and all is very simple. The most important working note here was the interest portion. That's all. If you identify this properly and calculate this properly, the whole problem is sorted. Okay. That way, this is a good question. Okay. So we have sorted this. Meaning solved, and I hope we are good. Okay, next, what is next? 2B is India's 34 ka question number 10, repetitive. 3A is India's 103 business combination ka question 40. Same or similar question is available. We'll only do the new answer. Yeah. This is available in question number 37 in India's 37 wala topic. Question number 4 is little different. One adjustment is different. So because of that, I'll do it. Rest everything we have done. Okay. So I'll start with the question number 4. 1 second. On 1st April 20x1, investor acquires 35% interest in XYZ. With 35%, you will only get significant influence. Okay, probably investment in associate equity method accounting, thereby exercising significant influence over XYZ. Okay, the investor has paid a total consideration of 47,50,000. For this 35% stake, we have paid 47,50,000 for acquisition of interest in XYZ. At the date of acquisition, the book value of XYZ ka net asset was 90 lakh. Fair value was 1.1 crore. So there is a difference. The investor has determined the difference of 20 lakh. 20 lakh as in 90 lakh minus 110 lakh. If you do, you're getting 20 lakh difference. Now that difference pertains to an item of PP which has a remaining useful life of 10 years. Fair value adjustments. We have done it in consolidation and all. So here the difference is due to fair value adjustments, and due to fair value adjustments, here fair value increases there. So you will get additional depreciation. So on this 20 lakh, you have to calculate additional depreciation for 10 years. There is no residual value. So additional depreciation is 2 lakh rupees. Correct? All this we have done in consolidation. But now they have asked the same adjustment from the associate perspective. That way this question is slightly different. Hence we are doing. During the year XYZ, the company, the associate company, XYZ is associate, right? They made a profit of 9 lakh. We know this, right? If associate company makes any profit, investment and associate balance will increase. Totally or investor share, our share, which is 35%. XYZ paid a dividend. When they pay dividend, investment balance will reduce to the extent of our share, which is 35% again. XYZ also holds a long-term investment in equity securities. Okay, they have not issued. They hold a long-term investment. So you know that if you purchase any equity shares of another company, you have two options, right? That financial asset, either you can measure using FVTPL method or FVT OCI method. appropriate category is FVTPL method, but there is an irrevocable option where company can go for FVT OCA, company ka choice. Here we'll see. Under Ind AS, the investment is classified as FVT OCA. The company has gone for this irrevocable option in accordance with Ind AS 109 and has recognized increase in the value of the investment by 2 lakh. Fair value increase. If you follow FVT OCA method, at every reporting period, you have to value the investment at fair value. So you may get some fair value gain or fair value loss. So here they're talking about increase. So this is a fair value gain. Doesn't matter, sir, if associate company has, there's an OCA. Doesn't matter whether it's a gain in the form of SPL or OCI gain, whether OCI is R or OCI NR, it doesn't matter. Here it is irrevocable option. So this is OCI NR, non-recyclable OCI. Doesn't matter, okay? Whether associate makes SPL, OCI or OCI NR, doesn't matter. Investment balance will still increase, yes? How much is the gain? 2 lakh. The investor, we have to record our share of this fair value gain. 2 lakh 35%, which is 70,000. Ignore deferred tax adjustment. They're asking you what is the closing balance of investment. Okay, pretty much similar, except this additional depreciation. That is one thing extra fitting over here. Rest everything. This additional depreciation was not there in our regular class notes. That question was not there. Now they've introduced this. That's all. Okay. So that we have done in consolidation. Same thing, you need to bring it in here. That's all is the difference over here. Okay. The first thing here, people, whenever we do investment, investment in associate is accounted as per equity method. So as per equity method, goodwill is calculated, but it is not recognized. Goodwill is only calculated for disclosure purpose. Okay. So it's better for examination. What you do is the way you calculate goodwill for consolidated financial statements, right? Whenever you do Ind AS 110 consolidation, you will calculate goodwill on consolidation with subsidiary. Same way as per Ind AS 103 also, right? Goodwill calculation is as per Ind AS 103, in fact, yes. So the same goodwill you calculate for investment in associate also. For associate also do the same goodwill. But this goodwill, it's not only for disclosure purpose. It is not accounted. It's only disclosed. Why? The assumption is whatever is the cost of investment you paid, that is assumed that it is assumed that the goodwill value is already included in the cost of investment. This I mentioned in the regular class. Whatever goodwill is there on associate consolidation, okay, we assume that it is already included in the cost of investment. But show the goodwill calculation separately. Either you can show like this goodwill calculation, Institute has got this as a balancing figure, or you can calculate the goodwill the way you used to do it for under Ind AS 103. That is also fine. Okay, but mind you, capital reserve is accounted separately. Goodwill alone is only disclosed, not accounted. In one of the consolidation problem, I have gone through this, where one question was there where we have associate ka consolidation as well as subsidiary ka consolidation, and that recording is uploaded there under the respective topic. There I've explained this. Okay, if you get any capital reserve associated with associate company, that is recorded. Only goodwill related to the associate company we do not record, because we assume goodwill means paying a higher price, right? So we assumed that the goodwill is already included in the cost of investment. That's the reason. How do you calculate goodwill? Usual. The consideration paid. How much did we pay for acquiring this 35% stake? 47,50,000. Correct, sir. This is for 100%. No, this is only 35%. So on the consolidation, what do? Add NCI. Sir, will NCI come for equity method? Associate? No. So what do we do, sir? Only compare our PC. Okay, this PC is for 35% with 35% share of net assets. That's all. NCI you ignore. So instead of taking there for consolidation, we used to compare fair value of net assets of subsidiary company as a whole, 100%. Here we don't own 100% of the company, we own only 35%, and NCI and all will not come for associate. So simply reduce what? Investor share of fair value of net assets. Don't take book value, take fair value of net assets. What is the fair value? Because we need there also we wrote fair value of net assets on the date of control. How much is the fair value? 110 lakhs. So 110 lakh our share is 35%, which will be 38.5. So what is this? So when you own equity shares of one company, the equity is basically an instrument which gives the holder the right over net assets. By owning equity shares in one company, you own that company ka share of net assets. So the total, your share of net asset is how much? By owning 35%, your share of net asset in the company is 38,50,000. So basically this is the net worth of the investment. The worth of your investment is only 38.5, but you paid 47.5. For 38.5, you paid 47.5. So you mean as an investor, you paid extra, meaning you incurred a loss. That loss only we coin it as goodwill, or we call it as goodwill. So the difference between these two is nothing but goodwill. Okay, this 9 lakh goodwill is only for sake of disclosure. It is assumed that it is included in the cost of investment itself. Okay, like this. You can show this working note separately. That is one way to present it. Same like consolidation, except ignore NCI part and don't take 100% of net assets. Take only your share, the investor share of net assets, which in this case is 35%. And always take the the fair value. Don't take the book value as such. That is one way. Now you can present like this also. This is the way institute present. In fact, this presentation we used to follow in accounting standard 23, if you remember. And back then when you wrote CA intermediate exam, when you wrote, if you remember, we used to present this way. That presentation ICA has followed. If you want, instead of this, you can present like this. Meaning, how do you present this? Simple. What is the book value of net assets? 90 lakh given in the question. And here our calculation is based on our share. What is our share of book value of net assets? 35%. So you told take fair value? No. First they take book value and they show the fair value adjustment separately. One and the same. Okay. One and the same. First they take book value of net assets 90 lakh into multiplied by our share 35% is this. Do we have any fair value increase in PP? Yes. How much? 20 lakh. That only they told 110 lakh minus 90 lakh. Here only we saw in the question. The difference is due to 20 lakh of fair value adjustment on PP. So 20 lakh ka 35%. If you calculate, that is 7 lakh. So if you add these two, what are you getting? 38.5. That's what we got here. No? So they have shown that separately. You can do it as one. It's okay. Or if you follow this presentation, your choice. Done, Asaru? This is one. Okay, 38.5. All right. Then what? Add goodwill, because the cost of the investment always, the carrying amount of investment, initially the investment as per equity method should always be shown at cost. What is the cost? 47 lakh 50,000. So adding these two, you're going to get 38.5. From 38.5, you have to go to 47.5. Hence, you add off goodwill also. That goodwill is arrived as a balancing figure. 38.5 minus 47.5, if you do, you'll automatically goodwill. That they're saying as balancing figure. So add these three to get the cost of the investment, meaning the initial value carrying amount of investment as per equity method. That's how they present it. That is their choice. Or you can present the working out like this, goodwill separately, and directly start with carrying amount of the investment on the acquisition date 47.5. You can prepare this working out separately and start this calculations from this particular data. That's a choice of presentation. I leave it to you. Okay, sir. This is the initial measurement of investment in associate as per equity method, right? Then what do you do? Thereafter, it's quite simple. What an all associate company did? Sir, they reported a profit of 9 lakh. So investment balance will increase only by our share. So 9 lakh ka 35% is how much? 3 lakh 15,000. So this will increase. Okay, sir. All right. Next, associate company paid a dividend. If associate company pays dividend, their net assets will reduce. So our investment balance also will reduce by our share. What is the dividend declared? 10 lakh. What is our share? 35%. So 10 lakh ka 35% is how much? 3 lakh 50,000. So reduce. That is one. Okay. Next, what happened? There's a fair value adjustment. Because of this, we are getting additional depreciation. Additional depreciation should be considered over here. Do not forget that. That is one thing. We used to consider this we used to consider this analysis of profits of subsidiary company, and the post-acquisition profit, we used to consider additional depreciation or reversal of additional depreciation. Here also that should be considered. In all our regular problems, this adjustment was not there. Hence, we had ignored this. Okay. So because of this, okay, you are charging additional depreciation. When you charge additional depreciation, because you are charging additional expense, means profit will reduce. So due to this adjustment, you have to reduce the profit of associate, right? So if profit of associate company reduces, means think, when due to additional depreciation, profit of associate will reduce. If profit of associate reduces, net asset of associate company also reduces. If associate ka net asset reduces, means obviously our investment balance also will reduce, because we have a share in their net assets. If net asset is reducing, that's what I said, no, match investment ka value with associate ka performance. If associate company is reporting profit, investment balance will go up. If associate company is reporting loss, investment balance will go down. Due to additional depreciation, profit will come down because it's a loss. So due to this loss, investment balance also will reduce. So what is additional depreciation? Fair value adjustment is 20 lakh. You have to useful life remaining is 10 years. So additional depreciation is 2 lakh. In subsidiary company, when you do consolidation, you will take whole 2 lakh because entire assets you record. Here, associate assets and liability will not record. No? So hence only take our share of additional depreciation, meaning investor share. Here everything is around investor share. Total additional depreciation is 2 lakh. 2 lakh ka 35% is how much? 70,000. So you have to do this what? You have to minus this. That's what they've done over here. Done, sir. That's all. Then there was some investment which associate company had. They had purchased some financial asset investment. Okay, some other company ka equity shares they had purchased, the associate company, and they are valuing that investment at FVT OCI. Okay, so that means there will be some fair value gain loss. So they only said that there is a value of increase. So this is a fair value gain. So how much is the fair value of gain on investment? 2 lakh. So it doesn't matter whether the associate company reports a realized gain or unrealized gain, whether it's SPL gain or OCI gain, investment balance will still increase. So how much is this OCI gain? 2 lakh. So investment again will increase by our share. 2 lakh ka 35%, which is 70,000 added up. That's what they've done. When you do all this, you'll get the final balance of associate company as per equity method. Adding all this, 47 lakh 15,000. That's all is this question. So every adjustment is same. All this we have done. Okay. The only thing new here is the one, show the goodwill either like in this format or in this format. The second one is if there is any fair value adjustments, and due to that fair value adjustment, if you are getting any additional depreciation or for that matter reversal of depreciation, that should also be considered. If you are charging additional depreciation, then it's a loss. So investment balance will reduce. If it's a reversal of additional depreciation, then profit will increase. Then it will be a positive number in that case. Here they have tested additional depreciation. Maybe in your examination, they may give you fair value decrease. Here it's a fair value increase 20 lakh. In your exam, they may also give a fair value reduction. Then it will be a reversal. All this adjustment we have done it in consolidation. Same thing can be fitted in associate wala equity method question also. That way this question is important or good or little different, you could say. Yes sir, hope you have understood that. Okay G, 4 is over. Next this is India's 33 ka same question. Question number 28 is there. 5th A we will do it. Okay, so maybe we'll do off for this and then we'll see further what's there. Only 1 or 2 more is there, that's all. Okay, next question, sir. A Limited is a company which is in the business of manufacturing engineering machines and providing after sales service. So we manufacture machines and we sell them and we also give service. So sale of machinery is probably one performance obligation to us and service is probably another performance obligation. The company entered into a contract with Mr. Anik to supply and install a machinery, namely Model Pi. The name of the machinery is Model Pi on 1st April. Great. On 1st April, we have made a contract that we will deliver. We installed also. Great. And to service this machinery on 30th September 20x1 and on 1st April 20x2. Keep that in mind. Sir, current year no is ending on 31st for the years. Okay. For both the years, they're asking the treatment. So, excuse me. Sir, you sold the machinery on 1st April 20x1. So that particular year will end on 31st March 20x2. Second service is given not in the current year, but on 1st April 20x2, meaning this second service, you are giving 2 service on the machinery. First service is given on 30th September 20x1 itself, that is current year. Next service you gave on 1st April 20x2, so which is in the next year. And you know this. So your revenue relating to service should be recognized only when the performance obligation is complete, when the service is complete, right? So this particular revenue will recognize only in the next year. Keep that in mind. The cost of manufacturing machine is 160. Cost is irrelevant, no, because we don't sell it at cost price. We obviously add profit margin and then only sell. It is possible for a customer to purchase both the machine Model Pi and maintenance service separately. Okay. So if any customer wants, he can buy only machinery or he can take only service. Or if he wants, he can go for both. So any combination is acceptable. So indirectly, this sentence is giving us a clarity as to what? The machinery and service, they are not highly interrelated or interdependent. Okay, they can function independently. That means what? If they are not interrelated or interdependent, these are 2 separate performance obligations. So India's 116 ka 115 ka rules we'll have to apply. Transaction price we'll have to allocate it to all the performance obligations. Okay. Mr. Anik is contractually obliged to pay 4 lakh on 1st April 20x2. Oh, sir. Sir, you delivered, you supplied the machinery and you installed the machinery on 1st April 20x1. But the payment you are receiving on 1st April 20x2 beyond 1 year. Beyond 1 year. So what am I indirectly hinting? SFC, significant financing component, right? So by default, we assume that if you are receiving the amount within 12 months, right? There is no SFC. That is one practical expedient in India's 115 says. Here it is going beyond 1 year, no? 1st April 20x2. So there is SFC. That means we cannot recognize revenue as it is. Some portion of the revenue will also include some interest income, which you have to book it as finance income or other income separately. For that, we need discount factor, which is given here. The prevailing rate for 1 year credit period guaranteed to the customer industry is 5% for the 6-month period. Okay, why? What is the 6 months period? We'll see. So they have given the rate for 6 months period, meaning 5% is a rate for 6 months alone. Why? In a bit we will see. Keep this in mind that this is the 5% for 6 months only. That's what they're telling in the question. As per the experience, the servicing of the machinery Model Pi was sold to Anik is expected to cost 30,000. Obviously, if you have to give service means you need to hire, you need to send your own employees or hire some employees and give service. Possible, no? Just because we are purchasing manufacturing machinery, service also we may not have employees to do the service also. We may outsource that activity to others. We will only manufacture and sell the machinery. We'll tell the customer we will give this service, but that service we may ask or we may outsource it to another third party vendor. So they're saying the service cost is expected to be 30,000 to perform the first service. 50,000 is the cost for second service. Obviously, the cost is that, but we normally don't sell the service at the cost also, right? Even though we are outsourcing this job, when we sell the service to the customer, we will always charge some margin. That's what they're saying over here. This is the cost of providing service. First service cost is 30, second guy is 50. Maybe I'll just box this for our reference. Assume the actual cost equal to expected cost. Great, all these are expectations. When A Limited provides mission service to customers in separate transaction, it earns a margin of 50% on cost. Okay, if you provide service alone if any customer wants, we charge. We don't charge, collect the service revenue on cost basis. We add, how much percent margin we add? 50% on cost. So whatever is the cost expected, to that we add 50%, and that becomes the revenue for us, service revenue for us. So first service cost is 30,000. 30 ka plus 50% if you do, that will be 45,000, because 30,000 ka 50% is 15,000. So the revenue for first service is 45,000, and revenue related to second service is 50,000 plus 50%, which will be 75,000. Okay, standalone selling price basically. Standalone selling price of service 1 is, I've written over here, is 30,000 plus 50%, which is 45,000. Service 2 ka portion is cost is 50, to that 50% margin if you add, you'll get 75,000. So this is a standalone selling price of service 1 and service 2. Okay, on 1st April 20x1, meaning on the day you supplied the machinery, installed the machinery, the cash selling price, here there is a delay in payment, so whenever there is a delay in payment, we have to record it at cash selling price. The cash selling price of the model Pi is sold to Anik at 251,927. So that means what, sir? This is a standalone selling price of the machinery, which is what, 251,927. So why is this necessary? For us to identify the income portion. See, totally we are charging how much from the customer? The deal is the customer will pay 4 lakh rupees. This 4 lakh rupees, is not for one component. It is for 3 components. What is that, sir? So one is towards machinery, goods. Another one is towards service, 2 services. That's okay. Third one, sir, since there is a delay in payment, we are collecting some interest. They have given the rate also, right? That is the balancing figure. Check. Totally you are collecting from the customer contract price or transaction price of 4 lakh. In this, machinery related revenue is 251, service related transaction price is for SSP is 45, service 2 is 75,000, adding the margin. So if you add all this, how much is it? 371. But we are not collecting 371 from the customer, we are collecting 4 lakh. So the difference between these two is nothing but your finance income, which is 278,073. This is the total. How to book it, with journal entry they've asked, I'll show it to you. This is a good question. Okay, sir, this is a funda. Now, what are they asking? The promised supply of machinery and maintenance are satisfactorily carried out on the time. So, on the due date, we have carried out, there is no delay. Now, the requirement. Segregate the components. They're not asking you performance obligation. They're asking you to segregate the components of the transaction that A Limited shall apply to revenue recognition and separately as per Ind AS 115. Okay. They're saying how many components are there in transaction. They're not asking about performance obligation. If they had asked performance obligation, I would have said 2. Machinery and service. They said components. Here there are 3 components. What is that? So machinery is a goods. Goods is one component. You're giving 2 service. So service is one component. Okay. Both the service are same. In a way. We know this. Performance obligation means a promise made in a contract to transfer a customer a distinct goods or service or series of distinct goods or service which are substantially same and have the same transfer pattern. So service number 1, service number 2 have the same transfer pattern. So they will be considered as one PO. Service 1 and service 2 both put together will become one performance obligation. If that asks performance obligation, it would have been goods is one PO, service is one PO, I would have concluded. But here they ask component. Since there is a delay in payment, it's clearly evident. Towards machinery, we charge only this much. For service, we charge this much. So adding all these 3, the contract price should have been only 371. But we are charging from the customer 4 lakh. So the difference between these two is nothing but your finance income. So the third component here is the finance income portion. These two you will apply Ind AS 115. Okay. You'll do the revenue recognition. Finance income you have to recognize. You will have to apply Ind AS 109 income provision. ACM accounting that you have to apply. Okay. So this basically you have shown it as an other income. So that is a component here. There are 3 components: goods, service, both the service put together, and then the finance income. This is the answer to the first requirement. Hope this is clear to everyone. Okay, Saru? Okay. Calculate the amount of revenue which A Limited must allocate to each component. Allocation we already done. Now this only is allocation. Out of 4 lakh rupees, SSP of machine is 251, service is this much, service 2 is that much. So this much will be allocated. The balance 28,073 is the finance income. Done, sir. For your reference, I have also told when the revenue should be recognized. I'll tell you with journal entry also. So machinery number 1, you installed. I hope this is clear. Just give you a minute. Okay, again, once just to repeat, contract price is 4 lakh. This is the SSP. Adding all these three, you get 371. But we're charging little more. That little more only becomes your finance income arrived as a balancing figure. Okay, sir. How much to book, when to book, in a bit I'll talk. Now when should we recognize this revenue? Which anyway we have to pass the journal entry. But here let's quickly discuss this. So machinery 1, when did you supply? 1st April 20X1. So current year itself. So since the machinery delivery and installation is complete, this 251 ka revenue will happen in the current year itself. When I say current year, I mean 20X1, X2. Okay. Yes. Alright. When I say next year, I mean X2, X3. Service 1. When did you give service? Service 1. We are giving 2 service. First service you gave on 30th September 20X1. So service is complete. So in current year itself, that is in 20X1, X2 itself, service revenue of 45,000 will recognize. What about service 2? Service 2 you gave on 1st April 20X2. 1st April 20X2 is current year? No, it is next year. So this particular service number 2 ka 75,000 revenue you will recognize only in the next year. That is 20X2, X3. Okay, sir. This finance income you will book it in the current year only. Why? I'll prepare an ACM table and I'll show you. Okay, sir. This also gets recognized in the current year. These are the 2 requirements which they have asked, which we have completed. Now, third requirement, pass the journal entries to record for both the years there what time toss. For current year, X1, X2 and X2, X3, for both the years, they're asking the journal entry. Okay. Sir, I have prepared the table here. Okay, this is nothing but ACM table, but prepared slightly differently. Actually, here, no, ACM table need not be really required. Without ACM table only, you can recognize interest. I think that's probably easier. Okay. First, I will try that. I'll explain that. And then I'll tell you the way I prepared this table also. First, let's go for journal entry because that is required. So first, now sir, 4 dates are important to us. Okay, what are those dates? Sir, first, you supplied the machinery on 1st April. So that is one date we need to keep in mind, 1st April 20X1. Then on 30th September, you gave first service. So 30th September 20X1, you gave service 1. This I'll call it as machinery. This is service number 1. Then on 1st April 20X2, you gave service number 2. This one. And first year will end on, okay, 31st March 20X2. So these are some 4 dates on which you have to do some accounting. What accounting you have to do over here, I'll tell you, but we keep that in mind. So these are the 4 dates on which we need to pass the journal entry. Okay, if we have this clarity, we can go on starting and doing the accounting. On 1st April, what happened? We supplied the machinery. So we are machinery dealers. So machinery is a goods. What is the journal entry for machinery sold, sir? It's a goods sold. So it will be financial asset debtors account debit because the customer is paying the amount next year, right? So it's a financial asset debtors to revenue account. Okay. So how much this machinery? We already know what is we have already allocated the revenue. What is machinery ka revenue? 251,927. 1 minute. Yeah, pass this journal entry for this. Okay, sir. Now this machinery is a goods. Whenever you sell the goods, your inventory balance will reduce. And inventory in our SPL we showed under cost of goods sold, right now. So inventory is an asset. Asset due to this should reduce. So the entry is cost of the goods sold to inventory. Because inventory is shown, closing stock is shown in your SPL as COGS, cost of the goods sold. Hence, the entry you pass is COGS account debit to inventory account. And inventory is shown not at the selling price, but at the cost price. Now, what is the cost price of the machinery they gave in the question? 1,60,000. So this entry you will pass to the extent of 1,60,000. So this is the first entry that you have to pass on, or first set of entries you need to pass on 1st April. Machinery sold. This is not PPE sold. This is machinery is a goods because we manufacture and we sell machinery. So you pass credit sale ka entry and you reduce the due to sale. Inventory will reduce and it is shown under COGS. So pass this entry. That is done. Next on 30th September. So stop there. Now they gave you the interest on yearly basis. No, they gave the rate of 5% for 6 months. That means indirectly what is the examiner hinting towards? You have to account the interest. Interest here, it's an asset. No, it's a financial asset. On financial asset, you have to book finance income. This finance income, no, you should not book it on an annual basis because the rate given here is 5% for 6 months. Every six months, once you need to pass the interest income. Okay, so now how to pass it? Very simple. You can calculate it using the table or you can calculate it straightforward way. What straightforward? So you are showing the debtor at 251. Correct, but will you recover 251 from the debtor? No, you will recover 4 lakh. But have you recovered that amount now? No. 6 months over payment we have not received. So we have to book 6 months ka interest income. It's a financial asset. So keep this in mind that it is an interest income. So what's the journal entry for interest income, sir? Financial asset account debit to finance income or interest income. How? Calculation is simple. What is the balance in debtors now? 251,927 into rate 5%. So you will not do 6 by 12. No. This 5% itself is the rate for 6 months. So calculate 251,927 ka 5% if you do, you will get 12,596. This is the interest you will book on 30th September. Got it, sir? Every 6 months you have to go on booking the interest. Either put up a table or straight away calculate like this. I feel this is easier. ICA has presented a table just to sync up. I have just made the table little simplified for you and present it again. That also I'll explain. First we'll go through the journal entry. Done? Okay, now this is on 30th September. Now 30th September, that's what happened. No. First service we gave on 30th September. Okay. So how much is the value? The cost of the service 1 is 30,000, but we will not give the service at cost price. We will add margin. What is our margin? 50% on cost. So what is the service 1 related revenue? 45,000. On 30th September, have you provided? Yes. So can you book the revenue? Yes. So has the debtor paid? No. So the entry will be financial asset debtor account debit to the revenue account. How much? 45,000. That is one. Okay, Saru. This is on 30th September. Now, sir, to provide revenue, to provide the service, you'll have to incur some cost. No, that's what they've given over here. The cost of service is how much? Somewhere they told, no. The cost of servicing the machinery is 30,000 rupees. And they're saying the expected cost and actual cost was same. So to give this service, we incurred a cost of 30,000. So it's like a service, maybe we have outsourced it. Okay. And that vendor is charging 30,000 from us. So service charges incurred. Expense. What is the journal entry for expense paid? Expense account debit to bank account. How much? 30,000 rupees. This is given to us as a question. Okay. Obviously, you'll give when you give the service only, you'll incur this cost. No? So cost also will get booked on the same date. Okay, sir. This is the entry on 30th September. Done. Okay, now the year will end on 31st March 20X. Now hang on. What is the debtor balance? Check where and all you have debited 251. Here you debited. Here you debited by 12. Here you debited by 45,000. And boxed number you add 251,927 plus 12,996 plus 45,000 if you do. Totally adding all this, you will get my calculator showing 3,09,523. Meaning on 31st March 20X2, we still have a debtor outstanding 309. Have you collected that payment? No, you will collect it on 1st April. But on 31st March, have you collected? No. So is there a delay? Yes. Should we calculate interest? Yes. But for whole year? No. First 6 months interest we have already calculated. Now, for the next 6 months, calculate the interest. But the balance in debtor now is how much? 309,523. And the interest for 6 months is how much? 5%. So on 31st March 20X2, year ending May, okay, don't book the revenue. Second service income will happen on 1st April. So on 31st March 20X2, we have still not collected the money from debtors. So because of this delay, we have to book finance income. At what rate? 5%. This 5% is for 6 months. First 6 months interest is already booked. Now for the next 6 months, calculate the interest. So this multiplied by 5% will give you 15,477. The entry is same, financial asset debtor account debit to finance income. Okay, people. Now, first year, May, 2 finance income is accounted. 12,596 and 15,477. If you add, how much is that? 12,596 plus 15,477. In fact, one entry I have not passed. If you want, you can pass it here only. This finance income, where it will be transferred to SPL. So the entry will be finance income account debit. Finance income account debit to SPL account. How much is that? 28,073. 28,073. This is on 31st March. One more entry will come for finance income transferred to SPL. That is what I wrote over here. The finance income of 28,073 also will be transferred to P&L in the current year itself. Now able to match out. So this finance income entirely will be transferred off to P&L in the current year itself. So first year ka full accounting drama is done. Done. Now overall, no. The very first day of next year, what will happen? We'll give second service, right? What is the second service amount? We already know. The cost of service is 50,000, but we are charging a margin of 50% on cost. The revenue is 75,000. So the journal entry will be, have you received the amount? No, first it's a due entry and then receipt entry. So the journal entry will be financial asset debtors account debit to revenue, 75,000. And to provide this service, we have to incur some cost. How much cost given? 50,000. So the entry will be service cost account debit to bank, 50,000. Okay. Now on the same day, no need to book any interest here because on the same day, 1st April only, you will collect the money from debtors. How much money totally you will collect? 4 lakh because contract price is 4 lakh. So now on 1st April 20X2, you will receive money from debtors. The journal entry will be bank to financial asset debtors 4 lakh. Now if you see debtors balance will become 0. If you want, you can reconfirm. Okay, here these boxed 3 figures where we boxed, we already added and we got it to be 309,523. Now again we debited by 15,447. Here we debited by 75. Here we credited by 4 lakh. Where and all are boxed, you add if you want once again. 251,927. Where and all you have debited, add. Where and all you have credited, minus. So 12,596 add. These two have added. Then 45,000 again we have debited. So add then again debit 15,477, so add. Okay, then here we debited by 75,000, so adding all this, my calculator is showing 4 lakh. Here you credited by 4 lakh, that means debtor balance became 0. That is what I'm trying to present in table also. This only is a ACM table, but here we have to prepare SIP differently because you have to charge the interest 6 months basis. So slight changes you have to bring in the table. But table, in fact, in my opinion, is not even necessary. See, without table, we calculated the whole thing with the journal entry. That's all. Now, the same way, I'll also explain in table. I hope this is clear for everyone. Done, sir. Now, this they asked, and they also asked you to prepare a note on revenue somewhere if you just check. Yeah, in fact, they had asked that. They're here, they've not mentioned. Maybe they cut it out. Okay. So, you have to give a note on revenue. Here, revenue means there are two components, selling the machinery and providing service. Two are revenue, and finance income is other income. So, in the current year, how much revenue you will book, you need to account. That we already know. No? Here, we already wrote. Machinery, we supplied in the current year. So, book it in the current year. Service 1, we gave it in the current year. So, 251,927 and 45,000. You will book it as a revenue in the current year. 20x1, x2. Service 2, you gave it in x2, x3. So, you will book it in the next year. Okay, now, sir. So, this is your revenue. Sale of goods and service becomes your revenue. And the finance income is other income you will book. It's not revenue. And the total finance income, you already wrote it here, 28,073. And we have calculated in table also. So, that will get counted in current year, that is 20x1, x2 itself. So, this is the note on revenue that ART asked. In I think this is also one of the previous MTP question. Okay. There they presented, here they're not. So better present of this also. Okay, that's the reason I've called out over here. Now, sir, this is the requirement of the question. Okay. Now, if you want to prepare the table, same ACM table, you're comfortable, no? So it is opening balance, then we charge finance income, then we charge, it's a financial asset. So we'll book receipt and then closing balance. Here, don't book it like that. After your finance income, no, bring in one more column called goods or service rendered. Okay. Bring in that to get the right amount of finance income. Otherwise, better I would suggest pass it directly. It's much easier. Okay, or this way also, if you're comfortable, you can pass. Same table, but just this is the extra fitting. And you get the closing balance, you add these three and deduct the receipts. So 2, 3, 4 you add, 5 you minus. So these three addition minus receipt will give you the closing balance if you have to produce. Okay. Now on 1st April, opening balance is 0 because debtor, you sold the goods only in the current year. So opening balance was not there. So opening balance, I've taken it as 0. So since opening balance was 0, finance income on 1st April, I'm not saying finance income is 0. Here you have to book the interest on a 6 months interval. Okay. So first interest you will book on 30th September. Next interest you will book on 31st March, end of the year. On 1st April, you will not book any interest. Hence, opening balance I'm not writing. If you write opening balance here, no, interest will come off. Interest you will not book it on 1st April. You will book it on 30th September. Hence, we are forced to insert one more column over here because of accounting. Okay, that's the requirement of the question. That's the reason. Okay. So goods, first year we sold a machinery worth how much? We already have here, no, 251,927. That's a value of machinery. Okay. Now, receipt, first year did we receive anything? On 1st April, in fact dates. On 1st April did we receive any money? No. So closing balances, these three ka addition minus this. So will be balance this. First, then this closing will become next 30th September ka opening. Okay. Now on 30th September, there is a delay and interest we have to book on a 6 months interval. Now on 30th September, what is debtor balance? 251. On this, you have to book finance income at 5%. And this 5% rate is for 6 months only. So directly multiply. This ka 5% if you do, you will get 12,596. That's what we got here also, if you just check. Okay. Right. That is one. Then on 30th September, again, did you give service? Yes. Second service you gave worth 45,000. Did you receive any money? No, 0. So adding these three minus this if you do, the debtor's ka closing balance on 30th September will become 309,523. That's what we got it here also, if you just check. Yes, same thing we're doing, but little more easy. Yes. Next on 31st March, this closing will become next opening. Now again, you book the interest on 30th September. Next interest you have to book 6 months later. That is on 31st March. So debtor balance is 309. On this multiply 5%, you will get interest income of 15,477. That's what we got it here also, 15,477. Okay. Did you give any service on 31st March? No. Did you receive any money? No. So these three ka addition minus this will give you debtor ka closing balance is 325. So first year has ended and debtor's ka closing balance is 325. Next year, 1st April 20x2, last year ka closing will become next year ka opening. Now, is there any finance income? No, on that day only it will settle. No, that day only it will settle. So interest will not come over here because on the same 1st April only it is settled. But on that 1st April, you gave a service of 75,000. We had to collect 325. We gave one more service of 75. So totally we have to collect how much? Adding all this 3, you will get 4 lakh. And we collected how much? 4 lakh. So debtor balance became 0 like that. Okay, sir. only 2 dates we have to book the interest over here. One is 30th September, another one is 31st March. That is what is the funda. So because we have to calculate the interest on a 6 months basis, we are forced to add one more column in our regular ACM table. That if you want to present it as this table, or my suggestion is you can do it directly over here because that looks pretty straightforward to me. But anyways, the choice is yours. This is all presentation. Okay, if you want, you can present this and this also. I mean, the entry is compulsory. Working note of finance income is optional. ICA has presented it. They presented a little more crazily. Okay, I've tried to simplify that. Done. Yes. So practice this question once, so you will get to know. Because once you solve it, once you practice it, this is a very straightforward question. First time when you look at it, no, you may understand it, but when you try to put it, or when you try to solve it, when you try to write it fully, you may commit some mistakes, especially in this table, because you're tweaking the table or making a small changes, no? So there could be some errors you could commit. Okay, or in journal entry, you may not commit some errors directly if you calculate interest to journal entry. Okay, sir. So this question is also done. This is 5A. Next auto 5B is India's 101 ka same question we have in class notes. I've given a reference here. This question 6A is professional and ethical duty ka class notes question 6-9. Then 6B question is India's 12 ka question number 9, same or similar. Okay. Then 6C ka is India's 8 ka question number 2. That means over, sir. One last question over, sir. That's one. One chain to question is there. Okay. India's 10 ka question we will see. The AGM of ABC for the year ended 31st March was held on 10th July. Okay, so if you read the requirement, they are asking India's 10 ka guidelines. Sir, you know this. For India's 10 talks about events occurring after reporting period. Only what, sir? Events occurring after a reporting period covers only those events that occur between the reporting date, meaning balance sheet date, which is usually 31st March, and the date on which financial statements are approved by the board of directors in case of company and other necessary authorities in case of other corresponding authorities in case of other entities be serious. No? So the relevant date here is balance sheet date and board of directors ka approval date. So we don't need a supervisory board ka approval date, AGM date, or any other regulator ka date and all. If they give, that is irrelevant. The date only, the window here. Events in this purpose means for India's 10 purpose, if you want to call it as an event means it should fall within that window. What is that window? Balance sheet date and the date on which financial statements are approved. That's all. Okay, so this is not really a new question. They're trying to confuse us or test our concept. So if you're clear, without even solving, we should get this question. Check. They're giving AGM date 10th July. Relevant? No, irrelevant. Okay. The board of meeting has concluded on 15th May. Is that relevant? Yes. Because when on the board meeting, board of directors meeting date, financial statements will get approved. So 15th May is the relevant date for us, for India's 10 ka perspective. Meanwhile, 1 second. Oh, there's some power issue, I think. Okay, recording is still running, so I think it's good. Meanwhile, the company had to disclose certain financial information pertaining to year ended 31st March 2022 to SEBI on 20th April. So obviously it's a listed company, so we have to give some data to SEBI, and SEBI is saying you have to give me the data by 20th April. Now tell me, sir, is this 20th April relevant for me? Irrelevant. Any other date other than board of directors approval date is irrelevant. So now they'll give many dates and trying to confuse us. Can we take this for India's 10 purpose, that day for India's 10 purpose? You can do whatever, macha. We will not get confused. In our mind, the question is already solved. Balance sheet date, financial statement, approval date by board of directors. That is given as how much? 15th May. Rest every date irrelevant. Since certain financial information pertaining to year ended 2022 is submitted to SEBI before approval of financial statement by the board, the management is suggesting, company ka management is saying 20th April shall be considered as after reporting period. They are saying we will take the events that occur between the current balance sheet date, which is 31st March 2022 and 20th April 2022. We will consider this as the window. We will take this as the window and for India's 10 purpose is what they're saying. We're giving some information on 20th April to SEBI. Can we take it? Not acceptable. Balance sheet date and the date on which financial statements are approved by board of directors. When did that happen? 15th May. So is the management view correct as per India's 10 guidelines? Sorry, boss, your viewpoint is wrong. The period for India's 10 purpose is balance sheet date 31st March 2022 and board of directors approval date, which is 15th May only. That's all you have to write. Oh, question, that's it. Theory question this was. So their view is wrong. 15th May, you have to go it up. Yes, sir. Yes. So with this particular MTP, I think rest all is answers. So all the questions relating to this MTP we have covered. Hope the session was helpful to you. All the very best for your examinations. Take care.